Have you ever felt like you have all the right trading tools, but the market still just feels like this completely chaotic, random mess?
Oh, I think everyone listening is nodding their heads right now.
Right. I really want you to picture this scenario because it is something almost everyone listening to this deep dive has experienced at least once, probably 100 times.
At minimum 100 times.
Exactly. So you've got the whole multi-monitor setup, glowing in the dark.
Now, the Spaceship Command Center.
Yes,
Okay.
spaceship. You spent a small fortune on the premium charting software. You have the custom indicators meticulously calibrated, the alerts are pinging on your phone, and you've got the financial news network running on mute in the background.
Just for the aesthetics, usually.
Basically, yeah. You've studied all the candlestick patterns, you know your risk management rules, so you sit down, you have your coffee in hand, and you are just locked in.
You're doing absolutely everything the industry tells you to do.
Right. And yet you take a trade and immediately, almost magically, it's like the market knows you clicked buy and actively decides to hunt your stop loss.
It feels incredibly personal.
It does. You get chopped up, you get faked out, you watch the price reverse, hit your stop, and then, of course, it rockets off in your original direction.
Without you.
Always without you. And you're sitting there in the glow of those 6 monitors wondering, why do so many smart, analytical, incredibly hardworking people struggle so much with consistency in these markets?
Well, that experience is basically a rite of passage. But the problem is, for many people, it becomes a permanent state of existence.
Yeah, they just get stuck there.
They do.
Yeah.
It is the ultimate frustration.
Yeah.
And what happens next is this very predictable, very destructive cycle of self-doubt.
Oh, I've been there. You start questioning everything.
Exactly. You walk away from the desk thinking, maybe I just need a faster data feed.
Yeah.
Or maybe there's some new proprietary indicator out there that I don't know about.
The magic bullet.
Right, the magic bullet. Or you think, maybe I need to draw my trend lines on the bodies of the candles instead of the wicks.
But that's going to change everything.
Right. You start looking for these external technological solutions to what is actually an internal philosophical problem. You're basically diagnosing the wrong disease entirely.
Because we naturally tend to think it's a tool problem, right? Like a software problem or maybe a discipline problem. Like we just weren't focused enough that morning.
That's what the industry wants you to think, yeah.
But the real story is most traders don't struggle because they lack the right tools or the right intelligence. They struggle because they fundamentally misunderstand time.
Time, yes.
Yeah.
It's the invisible variable that completely dictates market reality.
Which is wild because we never really talk about time in trading, just price.
We don't. And we are conditioned by our culture, by our technology, and honestly by the retail trading industry itself to look at the market through a very narrow, highly distorted temporal lens.
What do you mean by that? Like
Yeah.
we're too short-sighted?
Basically, yes. We view the market as a series of disconnected, immediate events.
Ah, okay.
And today, our mission for this deep dive is to tear down those retail trading myths you've been taught and rebuild a professional framework, one that's based on macro forces, capital flows, and structured cycles.
I love that. Because right now, the way most people operate, and the way I used to operate for years, honestly, is by thinking in moments.
Those isolated moments.
Yeah. You are looking for that perfect entry. You are waiting for a specific setup, like a little flash of confirmation on a 5-minute chart. You treat trading like you are this incredibly tense, coiled spring, just waiting for a trigger.
And when you think purely in moments like that, you create a completely fragmented view of reality.
How so?
Well, you are isolating every single tick, every single green or red candle from the broader narrative of what capital is actually doing.
You're losing the forest for the trees.
You're losing the forest for a single leaf on a single tree. If you see a breakout on your screen, you treat it as an isolated opportunity. You think, okay, price crossed this diagonal line. The pattern is complete. I must buy right now.
Right, because that's what the textbook said.
Exactly. And if you see a pullback, you treat it as a reset. A reversal is treated as this shocking, unpredictable surprise. There's absolutely no continuity in that mindset.
It's just reaction after reaction.
Just a relentless sequence of disconnected, high-stress decisions made in a total vacuum.
It sounds utterly exhausting when you lay it out like that. Like you are describing a recipe for complete psychological burnout.
Because it is.
Because when there is no continuity, when every single trade is just a fresh roll of the dice with no relation to the trade you took yesterday or the one you'll take tomorrow, what happens? You start overtrading.
Oh, no.
You jump in and out based on pure noise. You're Equity curve just becomes wildly inconsistent, and worse, you live in a state of constant confusion.
That's the worst part, the confusion.
Yeah. You don't understand why a setup worked perfectly on Monday but then failed miserably on Thursday. It makes no sense to you.
And the psychological toll of that is immense.
Yeah.
And it actually stems from a biological need.
Really? Biology.
Yeah. Human beings require a narrative. We need to understand cause and effect to feel secure in our environment.
That makes sense. We need a story.
Right. When you strip away cause and effect by only looking at these isolated 5-minute moments, the market ceases to be a mechanism. It starts to feel malicious.
Oh, man. It feels like it's out to get you.
It feels exactly like a casino that is actively rigged against you personally.
It reminds me of an analogy that really crystallized this whole concept for me.
Oh, let's hear it.
It's like playing a deeply frustrating game of whack-a-mole at a loud, chaotic arcade.
I love this analogy.
Right. Think about it. You're standing there with this giant foam mallet, and that mallet is your trading strategy.
Your moving average crossover.
Exactly. And you are just intensely staring at these empty holes on the board, sweating.
Heart racing.
Yeah. Suddenly a mole pops up, and that mole is your breakout, right? Your setup, your moment.
Oh, you swing.
You slam the mallet down, whack. You got it. But instantly, another mole pops up on the far side of the board.
So you scramble over there.
Whack! You swing and hit that one, then two pop up at once. You are wildly reacting to every single twitch, every flash of light, just swinging this heavy mallet back and forth until your shoulders burn and your vision blurs.
That visual captures the retail trading experience so perfectly. The sweat, the panic, the purely reactive nature of it all.
It's exhausting just thinking about it.
It is. But if we pull back from the player who's frantically swinging the mallet,
Yeah.
what are they failing to observe about the game itself?
Well, they aren't seeing the machine.
Exactly.
They are completely ignoring the gears, the wiring, the motherboard inside the arcade cabinet. There is an actual software program running that is deciding exactly when and where those moles pop up.
There's a master plan.
Yeah, but the player is entirely focused on the surface level symptom, the plastic mole, and completely blind to the underlying engine that's actually driving the game.
And that is the exact tragedy of the retail trader.
It really is.
To translate that back to the financial markets, markets do not move in moments. They do not exist as a random, chaotic sequence of popping moles.
So what are they?
Markets evolve through highly structured, continuous cycles. They are massive, slow-moving processes.
Driven by what?
Driven by macro forces and massive shifts in global capital flows that unfold over weeks, months, and even years.
Oh, minutes.
Definitely not minutes, until you force a shift in your own perspective to recognize that continuity. Until you look past the moles and see the machine under the cabinet. Absolutely no amount of tweaking your entry strategies is going to save you.
You're just changing the color of your mallet.
Exactly. You can buy a lighter mallet, you can drink 3 energy drinks to improve your reaction time, but you are still just playing a reactive game that you are mathematically destined to lose.
Because you are never anticipating, you're only reacting.
Always a step behind.
Now, here's where it gets interesting. Because if we start talking about market cycles, I can already hear people listening to this saying, I know about cycles. I read a textbook on day one, uptrend, downtrend, range.
Oh, the classic textbook cycle.
Right. But when a new trader opens up a typical trading manual to learn about cycles, what kind of picture are they usually painted?
They are painted a picture that is fundamentally deceptive, honestly.
Deceptive. How so?
Well, the standard retail definition of a market cycle almost entirely reduces the concept to visual geometry.
Okay, geometry.
Yeah, they teach you to look at a chart and identify flat, two-dimensional shapes. They point to a zigzag line, go into the top right and say, hey, this shape is an uptrend.
And a zigzag going bottom right is a downtrend.
Exactly. They draw a sideways box and label it accumulation, and then they draw another box at the top of the chart and confidently label it distribution.
Okay, I want to push back on that for a second.
Go for it.
Why is it so incredibly dangerous to reduce a market cycle to simple shapes and lines? I mean, human brains are literally wired for visual pattern recognition.
We are, yeah.
It's how we survive as a species. If we see a pattern repeat 100 times, shouldn't we trust it? Why is that such a trap in trading?
Because visual labels only describe what price looks like in the rearview mirror.
After the fact.
Right. They tell you absolutely nothing about the underlying cause of that movement. And in a complex system like the global financial market, confusing correlation with causation is fatal.
So the shape isn't the cause.
Never. If you reduce cycles to shapes, You turn trading into mechanical pattern matching. You literally start labeling charts like a robot on an assembly line.
Oh, man, I used to do exactly
We
that.
all did. You look at the screen and say, I see a left shoulder, there's the head, there's the right shoulder. This must be a reversal.
The classic head and
Right.
shoulders.
You are searching for visual repetition instead of searching for fundamental causation.
You're trying to force the live, breathing market to match a static picture you saw in a textbook.
Exactly.
But the market doesn't know what textbook you read.
It definitely doesn't.
Yeah.
The market is a massive, complex, highly adaptive system of millions of participants.
Okay.
It doesn't care about the geometry you drew on your screen.
It really doesn't.
So when you rely purely on recognizing a shape to dictate your financial decisions, what happens when the market inevitably deviates?
Oh, it's a disaster.
What happens when that beautiful textbook accumulation box that you bought the absolute bottom of suddenly drops right through the floor?
You freeze. You experience total paralysis because your only tool was the shape itself.
Yep, the shape was everything.
And when the shape breaks, your entire framework for reality breaks with it. You have no idea what to do next, do you? Because you never actually knew why the shape formed in the first place.
And so the entire foundation collapses. You are left holding a massive loss, just staring at the screen, wondering why the pattern failed.
The book lied to me.
Exactly. But the pattern didn't fail. The pattern was never a law of physics to begin with. Your understanding of the market was just entirely superficial.
That is a tough pill to swallow for a lot of people.
It is, but this is why we have to throw away the shape-based definition entirely if we want to build a real professional operating system.
Okay, so if we throw out the shapes, what replaces them? We need a new definition.
We do. The true institutional definition of a market cycle is this. A market cycle is the full progression of capital, driven by a dominant macro narrative, from its initial initiation to its ultimate exhaustion.
Wow. The full progression of capital driven by a dominant macro narrative. That is a heavy sentence.
That changes everything.
It completely shifts the focus away from the flickering lights on the screen and onto the actual flow of money.
Because the money is the only thing that actually moves the needle.
Right.
We must prioritize causation over recognition. Every single true market cycle begins with a fundamental imbalance.
Not a moving average crossover.
Definitely not. It does not begin because a moving average crossed another moving average. It begins because something in the real world physically or economically changed.
Give me some examples of that.
Sure. Maybe it's a massive shift in central bank policy.
Like raising interest rates.
Right. Maybe it's a war breaking out that suddenly disrupts global supply chains. Or maybe it's a sudden terrifying energy shock or a massive influx of government liquidity.
Like stimulus checks.
Exactly. That real-world event creates a fundamental imbalance between supply and demand.
And when that imbalance happens, capital and by capital, we are talking about the big money, right?
Oh, the massive money.
The sovereign wealth funds, the massive pension funds, the institutional hedge funds, they can't just sit on their hands.
They literally can't. They have mandates. They have to reallocate their billions based on this new reality.
That is the core mechanism right there.
It is. The real-world imbalance happens. Capital is forced to respond to that imbalance by flowing into new, advantageous assets and flowing out of vulnerable ones.
And so what is price then in that context?
Price is merely the footprint left behind by that massive reallocation over time. Price is just the symptom.
The flow of capital is the underlying disease.
Exactly. If you want to stop playing whack-a-mole, you have to stop staring obsessively at the footprints and start tracking the beast that's actually making them.
I really want to visualize that beast because capital of that magnitude doesn't just teleport from point A to point B.
No, it takes immense time.
It takes time to move billions of dollars. It moves in distinct phases. It has an anatomy.
A very specific anatomy.
So let's actually dig into the structure of how a true cycle unfolds, starting from the very beginning. Phase 1, the initiation phase. What does this actually look and feel like on the ground?
Phase 1, initiation, is defined by one core concept: dislocation before consensus.
Dislocation before consensus.
Right. As we just established, every cycle begins with a disruption, a shock to the system. The old, comfortable narrative that everyone was used to is suddenly and violently challenged by a new reality.
Give me a tangible example of what that shock looks like in real time.
Let's look at the massive inflation shocks of 2022.
Oh, that's a perfect example.
Right. For a decade, the market was perfectly comfortable in a zero interest rate environment. The consensus was that inflation was dead.
Totally dead. Free money forever.
Exactly. Then suddenly the CPI prints start coming in hot.
Then hotter.
Then terrifyingly hot. And the central banks, who had been saying inflation was quote-unquote transitory,
I remember that word.
right, they suddenly pivot violently and start hiking rates at a historic pace. That is a shock. That is a dislocation.
So in this very early stage, when that first hot inflation print hits, how does the broader market react? Are people immediately jumping on board the new trend?
Not at all. In fact, the broader market is entirely misaligned.
Really?
Yes, everyone is deeply confused. The assets price, let's long-term government bonds or growth tech stocks, is suddenly massively mispriced relative to this brand new reality of high interest rates.
Right.
But participation from the retail crowd is incredibly low.
Wait, I have to stop you there.
Okay.
If the new reality is printing on the front page of the Wall Street Journal, and the central bank chairman is literally on television announcing rate hikes, why is participation low? Why isn't everyone immediately trading the new reality?
Because of human psychology, specifically something called anchoring bias.
Anchoring bias.
Yeah. Human beings anchor their expectations to the recent past. The defining characteristics of the initiation phase are sharp, often violent repricing events, followed immediately by intense narrative confusion.
So people are basically fighting the new reality.
Yes, the old guard is actively fighting the new data.
Yeah.
You see analysts on TV saying, oh, this is just a blip. Rates will go back to zero next month.
Denial, basically.
Pure denial. There's very low conviction from the herd. Consequently, the price action looks incredibly erratic. It swings wildly. It looks scary.
Which perfectly explains why most retail traders completely miss this phase.
They miss it every time.
They are sitting on the sidelines, paralyzed, while the actual foundation of the news cycle is being poured. Why? Because this phase entirely lacks the comforting, warm blanket of confirmation that they have been explicitly taught to wait for.
They want it to be easy.
They are waiting for a pristine trend line to form, but you can't draw a neat little trend line on a violent, chaotic dislocation.
You absolutely cannot.
Right.
Retail is waiting for permission from a chart.
Permission from a chart. Wow.
But informed capital, the smart money, the massive macro funds, they don't need a chart's permission to act.
No, they have their own research.
Right. Informed capital enters during the initiation phase, not because the trend is obvious. The trend doesn't even exist yet.
So why do they enter?
They enter because the fundamental imbalance is glaringly visible to them.
Oh.
They see the macro shift, they run their models, they realize the asset is mispriced by, say, 30%, and they start quietly or sometimes violently deploying capital to capture that dislocation before the rest of the world wakes up.
So while retail is waiting for clarity, smart money is aggressively buying the confusion.
Exactly. They are buying the fear and the confusion.
That is a massive paradigm shift in how to view early price action. But eventually, that confusion has to fade, right? The news spreads, the economic data keeps hammering home the new reality month after month, and we transition into the second phase.
Yes, we move into phase 2, expansion.
Expansion.
This phase is characterized by alignment and trend formation. The macro narrative that was so confusing and heavily debated a few months ago suddenly becomes the accepted, undeniable reality.
The fog lifts.
The fog lifts. And because the narrative is finally clear to a broader audience, capital begins to align in a massive, coordinated way.
Everyone gets on the same side of the boat.
Right. And this is where those sustained, powerful, beautiful trends are actually formed.
Looking structurally, like on the chart, this is where things start looking exactly like the textbook.
Exactly like the textbook.
This is where the retail trader finally breathes a sigh of relief and says, aha, an uptrend.
They finally feel safe.
You get clean directional movement, you get continuation patterns like bull flags and pennants that actually work and hit their targets. You buy a pullback and hey, it actually bounces instead of stopping you out.
That's because the pullbacks are being absorbed by eager institutional buyers who are using any slight dip to build massive positions.
They're just gobbling up the liquidity.
Yes. This is the phase where true campaigns are built and executed by professionals. You aren't just taking a quick, stressful scalp for 20 ticks. You are riding a wave of massive, undeniable capital reallocation.
Let me play devil's advocate here for a second, because a lot of technical traders will look at that expansion phase, they will see that beautiful, clean trend line, they will see the perfect bull flag, and they'll say, see, the technical pattern works. The strength of this trend is coming from this perfect geometry. If I just master drawing this flag, I'll be rich.
And that is the ultimate illusion of the expansion phase.
Break that down for me.
The pattern is not generating the strength. The pattern is not some magic spell that summons buyers from the ether.
It's not casting a spell on the market.
No. The strength, The momentum, the underlying reason those pullbacks are bought so aggressively comes purely from the fact that more and more market participants are actively aligning their capital with the underlying macro driver.
So the chart pattern is just a visual representation of mass human agreement.
Exactly. Think of the macro driver as the engine of a high-performance car.
Okay, I like this.
Capital is the fuel being pumped into that engine.
Got it.
The technical chart pattern you see on your screen is just the speedometer on the dashboard.
Oh, that's brilliant.
Right. Looking intensely at a speedometer doesn't make the car go faster. The engine does.
If you tap the glass on the speedometer, you don't speed up.
Exactly. In the expansion phase, the engine is roaring, the fuel is pouring in, and the speedometer is naturally climbing.
But as we know, engines cannot rev in the red line forever.
They certainly cannot.
They eventually run out of fuel. Which brings us to the dark side of the cycle. The phases where retail traders almost always get completely trapped, chopped up, and destroyed.
This is where accounts go to die.
Let's get into the danger zone. Phase 3. Maturation. This is where the party gets a little out of hand, isn't it?
It is. Maturation is defined by consensus and severe crowding.
Severe crowding.
Yeah. Think about that dominant macro narrative, the one that started as a confusing shock in phase 1 and then became a strong, clean trend in phase 2.
Yeah.
By phase 3, it is everywhere. It is the accepted, undisputed consensus of the entire planet. It's on the front page of mainstream, non-financial news websites.
Your neighbor at a weekend barbecue is suddenly asking you how they can open a brokerage account to trade this specific asset.
Ah, the classic barbecue indicator.
The ultimate contrarian warning sign. When everyone agrees on a trade, watch out.
It is a cliche because it is fundamentally true regarding capital flows.
How does it affect the flows?
The positioning in the market becomes incredibly crowded. Everyone is on the exact same side of the boat.
The boat's starting to tip.
Exactly. And structurally, on your charts, you start to see a very distinct shift in behavior.
What does it look like?
The trend begins to slow down. The easy, clean money has already been made by the early actors.
Right.
Volatility starts to increase significantly within the trend structure. You start getting wilder intraday swings and much deeper, scarier pullbacks that take longer to recover.
But if I'm looking at a daily chart, the price might still be technically moving in the same direction, right? Like it's still eking out higher highs.
Yes, and that is precisely the trap. Price may still inch higher, but the quality of the price movement has fundamentally degraded.
The quality.
Yeah, it takes twice as much effort, twice as much volume, and twice as much time just to push the price up a few measly ticks.
Because there's hardly anyone left in the world with capital left to buy. Everyone who wanted in is already fully invested.
Exactly. The late participants, the retail traders, who cautiously waited for ultimate, undeniable confirmation over months and months.
Because they wanted to be safe.
Right. They're jumping in right here. They're buying the top. And they're making a fatal cognitive error.
What's the error?
They're mistaking the sheer persistence and duration of the trend for actual underlying strength.
Oh, wow.
I think, well, this asset has been going up every month for a year. It must be an incredibly safe, strong investment.
It can't possibly go down now.
No, it's exhausted.
Yeah.
You aren't joining the start of a new, vibrant cycle. You are buying the final, gasping breaths of a dying one.
Which perfectly tees up phase 4, exhaustion.
A brick wall.
The end of the road. You mentioned earlier that cycles don't end just because the news changes. Why do they actually end?
What's fascinating here is, this is a critical mechanic to understand, cycles do not end simply because the financial media stops talking about the narrative.
Right.
They don't even necessarily end because the central bank suddenly reverses course overnight.
Yeah.
They end because the marginal benefit of acting on that specific narrative drops to absolute zero.
Let's unpack that. For someone newer to macroeconomics, what does marginal benefit dropping to zero actually mean in practical, mechanical terms? How does that trap capital?
It means all the future expectations regarding that narrative have already been fully priced into the current value of the asset.
Okay, give me an example.
Let's go back to our interest rate example.
Yeah.
If the narrative was central banks are going to hike rates to fight inflation, well, by the exhaustion phase, the market isn't just pricing in today's rate hike.
Because they're looking ahead.
Right. It has aggressively priced in the next 5 anticipated rate hikes. So even if the central bank comes out and raises rates again exactly as expected, it doesn't matter.
The market shrugs.
The market completely shrugs. There is no new surprise. There is no new fundamental imbalance to exploit. The massive institutions that rode the wave up have realized, The juice has been entirely squeezed from the lemon.
Okay, so mechanically, what are those institutions doing with their massive positions? And what does that actually look like on the screen for the retail trader sitting at home?
Mechanically, the smart money is beginning the process of institutional distribution.
Unloading their bags.
Exactly. They have billions of dollars in profit, but they can't just hit a market sell button. They would crash the price and ruin their own profits.
Right, there's not enough liquidity for them to just dump it all at once.
Precisely. So they have to quietly and methodically offload their massive positions onto the late arriving retail buyers.
The people from the barbecue.
The barbecue crowd, yes. On the screen, this looks like pure, agonizing frustration. The trading setups that worked beautifully a month ago suddenly stop working.
Like you buy a textbook breakout.
It fails instantly, traps you, and reverses violently.
You try to play for trend continuation.
There is absolutely zero follow-through. Price just chops sideways in this violent, erratic, wide range.
Because every time the price pops up slightly, an institution uses that liquidity to sell another massive chunk of their position.
Exactly. The chop is just institutional distribution, masking itself as a continued trend.
That is so sinister but brilliant.
And the tragic part is, the retail trader sitting at home thinks the market has just gone random.
Or they think their specific technical strategy is broken.
Yes, they think, oh, my 14-period relative strength index isn't catching these swings perfectly anymore. Let me tweak the settings to a 20-period RSI.
They try to optimize their micro tools because they are completely blind to the macro environment.
Yes, the choppiness is not randomness. It is a highly specific, very loud signal. It is the market screaming at you that the flow of capital that was sustaining this entire cycle has stopped increasing.
The fuel line has been cut.
Exactly. Buying pullbacks and chasing breakouts only works in the expansion phase. In the exhaustion phase, doing those exact same actions is financial suicide.
Which brings us to the final and potentially most account-destroying phase of them all, phase 5, transition.
The absolute no man's land.
What happens here?
In the transition phase, the old cycle is definitively, undeniably broken. The distribution is complete, but the new cycle,
Yeah.
the new dominant narrative that will drive the next year of price action, it hasn't been established yet. The market is in a profound state of flux.
It's like being between jobs, but for global capital. The money is sitting in cash, waiting for a new directive.
That's a perfect analogy. You have conflicting signals everywhere. You get massive structural breaks on the chart, huge, terrifying drops, but then there's no real follow-through to the downside either.
Just a mess.
A total mess. The market becomes incredibly hypersensitive to every tiny, insignificant piece of economic data because it is desperately, blindly searching for the next big imbalance to latch onto.
And here is the massive trap, the behavioral flaw that I think ruins so many retail accounts.
What's that?
Traders aggressively try to refine their strategy in this phase.
Oh, absolutely.
They take a few losses, get frustrated, and think they just need to trade harder. They need to trade more often. They stare closer at the screen, trying to find the hidden signal in the noise.
They're trying to force it.
They don't realize the environment itself has fundamentally changed. The very rules of gravity have shifted. This is a time for observation, for keeping your capital safely tucked away, not for aggressive leveraged positioning.
If you try to force trades in a transition phase, you will suffer death by 1,000 cuts.
Just slowly bleeding out.
You will bleed your account dry before the new cycle even has a chance to begin. You have to develop the professional maturity to sit on your hands, preserve your mental and financial capital, and simply wait for the new initiation phase to show its hand.
Okay, this is a lot to process, so let's zoom out for a second, because we've thrown around a lot of terms today. Macro narratives, cycles, price structures.
A lot of vocabulary.
It is. We need to build the master framework, so you, listening right now, don't get these concepts tangled up in your head, because there is widespread confusion about the hierarchy of these forces. Let's clearly differentiate between regimes, cycles, and structure.
This hierarchy is critical for organizing your thoughts. Think of it like a set of Russian nesting dolls, from the absolute largest to the very smallest.
Okay, Russian nesting dolls.
The largest outermost doll is the regime. The regime is the overarching dominant macro environment. It is the global weather system.
Give me some examples of a weather system.
For example, are we in a globally inflationary regime or a disinflationary one? Are central banks worldwide tightening liquidity by pulling money out of the system? Or are they easing by printing money?
Like quantitative easing.
Right. Are we in a secular risk-on environment or a risk-off defensive environment? Regimes are massive. They last for years, sometimes entire decades.
Wait, I want to clarify something there. You mentioned a secular risk-on environment. For someone newer to macroeconomics, what does secular actually mean in this context? Are we just talking about long-term greed?
Great question. In finance, secular simply means a long-term, overarching trend that persists regardless of shorter-term economic fluctuations.
Okay, so a secular trend is the big picture.
Exactly. A secular disinflationary regime, like we saw from the 1980s all the way to 2020, means that for 40 years, the overarching gravitational pull on inflation was downward.
Wow, 40 years.
Yeah, driven by globalization and technology. That is the massive, inescapable backdrop. That is the regime.
Okay, so the regime is winter or summer. It's the climate. Then what is a cycle?
If the regime is the climate, the cycle is the specific weather pattern within that climate.
Like a blizzard during winter.
Yes. A cycle is how capital moves, breathes, and reallocates within the strict confines of that regime. And this is a vital distinction. One single regime can contain multiple distinct cycles.
Walk me through a historical example of that. How does a cycle operate within a regime in practice?
Let's use a regime of global tightening. The central banks are actively raising interest rates to kill inflation.
Okay, that's the multi-year regime.
Right. Within that massive backdrop, you might have a vicious 6-month cycle of extreme U.S. dollar strength as global capital panics and floods into the safety and high yield of the U.S. dollar.
Right, a flight to safety.
Exactly. That specific dollar strength cycle goes through the exact phases we discussed: initiation, expansion, maturation, and exhaustion.
But when it exhausts?
The tightening regime isn't over. Instead, you might enter a transition, and a new cycle begins, perhaps a 3-month retracement cycle where the dollar weakens temporarily as the market digests the initial shock.
Before the primary tightening regime reasserts itself.
Yes, and a new cycle of dollar strength begins.
Got it. So the cycle is the wave, but the regime is the tide underneath it all.
That's a great way to put it.
And then at the very bottom, the smallest, innermost nesting doll is structure.
Yes. Structure is what traders actually see when they pull up a chart on their screens. The higher highs, the lower lows, the geometric trend channels, the consolidation boxes.
The footprints in the sand.
Exactly. Structure is merely the expression of the movement. It is the visual byproduct of the cycle playing out. It is absolutely unequivocally not the cause of the movement.
So if we connect this to the bigger picture, cycles act as the crucial bridge connecting the macro to the structure, connecting the invisible why to the visible how.
That is the master key to professional trading. The macro regime tells you why massive amounts of capital want to move.
Right.
The structure tells you how it is currently moving on a tactical level.
Right.
But the cycle is the vital bridge that connects the two.
Without deeply understanding the cycle phase, you are flying blind.
Completely blind. You essentially face two terrible fates. You either become a pure macroeconomist who writes brilliant, sweeping research papers but can't time a trade to save their life.
Because they completely ignore market structure.
Right. Or, on the other extreme, you become a pure technical day trader who obsessively memorizes candlestick patterns but constantly gets run over by the macro train.
Because they have absolutely no idea what the fundamental context is. It's like trying to understand a complex global economy by exclusively staring at a stock chart of one company.
Completely ignoring what the central bank is doing.
Ignoring massive shifts in supply chains, ignoring global capital flows. It's madness when you say it out loud.
It is complete madness. But it is exactly how 95% of retail traders operate every single day.
And it perfectly explains why the failure rate in this industry is so astronomically high.
It does.
So that raises a massive question. Why is thinking in cycles so incredibly rare? If this is the master framework that institutional professionals actually use to manage billions of dollars, why is the retail space so obsessed with lines, shapes, and moments?
Because there is an entire industrial complex built around teaching terrible habits.
We need to deconstruct the flaws in how this industry actually teaches people to interact with the market.
We really do. The retail education complex thrives on simplification, and these bad habits are deeply ingrained in almost everyone who opens a brokerage account.
Let's break them down.
There are 4 fatal flaws in how trading is commonly taught. If you want to survive and actually achieve consistency, you have to unlearn these immediately.
Number 1.
The most glaring flaw is the massive obsessive overemphasis on entries. The industry teaches you to prioritize micro-precision over macro context.
Oh, I've seen people spend hundreds of hours agonizing over whether to use a 14-period moving average or a 20-period moving average to get the quote-unquote perfect entry signal.
Yes, they obsess over shaving a few pennies off their entry price.
Like, that's going to make or break the trade?
And by doing so, they are completely ignoring the fact that they are buying into a market that is in late-stage exhaustion.
Oh, wow.
It genuinely does not matter how perfect, how mathematically precise your entry is. If you are buying the very top of a dawning cycle, you are just perfectly executing a terrible idea.
A pristine entry cannot save a fundamentally flawed premise.
Context must always, always dictate the entry, not the other way around.
If people are so obsessively focused on these micro entries, I imagine that completely distorts their sense of time, right? They must be staring at incredibly short-term data to find those micro fluctuations.
That leads directly to the second fatal flaw: time frame compression.
Time frame compression.
This is a terminal disease in the modern app-based trading era. I am talking about the absolute dominance of the 5-minute chart, or even the 1-minute chart.
The charts that give you a constant dopamine drip every second is a new event.
They provide constant action and constant stress. But remember our definition of a true cycle: the massive movement of global capital driven by macroeconomic narratives.
Right, which takes months.
Think about the physics of that. You cannot possibly see a macro cycle unfold on a 5-minute chart. Cycles take days, weeks, and months to develop.
So when you look at a 5-minute chart,
When you aggressively compress your time frame down to minutes, you completely remove your own visibility. You are staring intently at a single leaf through a high-powered microscope, desperately trying to figure out which way the wind is blowing in the entire forest.
it is mathematically impossible to gauge the macro environment from that perspective.
You are just trading the noise. You're trading against random algorithmic execution bots, not actual directional capital flow.
You are playing a video game. Which makes me think about how people approach the rules of these systems. The industry loves to sell these rigid mechanical systems, right? Just follow these 3 simple rules and make $1,000 a day.
That is the third fatal flaw: mechanical thinking.
Mechanical thinking.
The industry sells the incredibly seductive dream of rigid, repeatable, easy-to-follow templates. If indicator A crosses line B, then immediately execute action C.
They treat the financial market like it is a simple, closed computer program.
We do.
It appeals to human nature because we deeply crave certainty. We want a formula.
We want a formula because formulas are safe. But markets are not mechanical. They are highly adaptive, fluid, incredibly complex organic processes,
Driven by human beings.
driven by millions of human beings and complex machines reacting to constantly changing conditions. If you treat a fluid, dynamic environment with a fixed, rigid template, you will snap in half the moment the environment adapts.
So cycle thinking requires adaptability.
Adaptability and nuance, not rigid, inflexible rules.
And I assume the ultimate flaw in all of this mechanical, short-term chart reading is that it completely divorces the trader from the real world. Pure technical analysis treats the price chart like it's a closed ecosystem, doesn't it?
That is the fourth and final flaw: ignoring capital flows entirely.
Ignoring the money.
The entire underlying premise of pure, unadulterated technical analysis rests on the efficient market hypothesis,
Right. The idea that price is a self-contained entity.
that all known information is already perfectly reflected in the price, and therefore you don't need to look at absolutely anything else.
Right. The chart is God. Nothing else matters.
But price is not an entity. Price has no mass. Price has no independent will. Price is simply a reflection of capital reacting to real-world incentives.
Like a shadow.
Yes. If you completely ignore the incentives, the changing bond yields, the central bank liquidity, the shifting geopolitical policy, and you only stare at the reflection in the mirror, you are engaging in pure pattern recognition without a shred of actual deep understanding.
Okay, we've effectively torn down the old house.
Demolished it.
We've exposed the whack-a-mole illusion, the geometry traps, the fatal flaws of time frame compression, robotic thinking. But we can't just leave you, the listener, standing in the rubble.
No, we have to rebuild.
How do you, listening right now, actually purge these bad habits from your daily routine? How do we build a new professional operating system that actually works in the real world?
We have to shift from this philosophical theory into incredibly practical daily application. The very first step in building this new operating system is a complete mental pivot in how you view your job as a trader.
What's the pivot?
You must start prioritizing processes over isolated trades.
Processes over trades. Give me an example of what that internal monologue actually sounds like for a professional versus a retail trader.
The old internal monologue, the retail mindset, asks one single question constantly throughout the day. Is this a good entry? Should I hit the buy button right now?
Very action-oriented.
It is entirely obsessively focused on the isolated action of executing a trade. The new professional internal monologue stops asking that entirely.
What do they ask instead?
You must train yourself to sit down at your desk, look at the broad market, and ask a much bigger question first. Where are we currently located in the macro cycle?
You have to locate yourself on the map before you ever decide which direction to start walking.
Precisely. Because a trade is no longer an isolated random event. A trade is simply a micro expression of a macro progression.
If you do not intimately understand the progression, you have absolutely no business taking the trade.
None at all.
And I imagine once you know where you are on the map, it completely changes how you view risk. This plays perfectly into the idea of aligning with asymmetry.
Yes, asymmetry is everything.
Because the reality that retail traders hate to hear is that opportunities in the market are not evenly distributed. They don't just happen randomly at all hours of the day, do they?
No, they don't. And this is a very bitter pill for hyperactive day traders who feel they fundamentally must trade every single session to justify sitting at their desk.
I'm a day trader. I have to trade every day.
Right. But the empirical truth is the market only offers highly asymmetrical risk-to-reward opportunities during very specific phases of the cycle.
So where are the fat pitches? If I want maximum reward for minimum risk, where is the asymmetry?
The best, cleanest directional opportunities sit very early in the expansion phase.
Why there?
Let's look at the mechanics. The macro narrative is finally clear. Capital is aggressively aligning and flowing into the asset, but the retail herd hasn't fully crowded the trade yet.
So you have tailwinds.
The trend has maximum underlying energy and minimum frictional resistance. That's the first spot. The other point of massive asymmetry is late in the exhaustion phase, but specifically for playing reversals or structural transitions.
Playing the snapback.
Yes. When the rubber band is stretched to its absolute agonizing breaking point by late-arriving retail buyers, the structural snapback can be incredibly powerful and lucrative.
But if you are trying to force huge directional trades during maturation, when the trend is visibly slowing, chopping, and grinding,
It's a nightmare.
or during the transition phase when the market is utterly confused and directionless, you are fighting an uphill battle in the mud.
You are taking on maximum uncalculated risk for absolute minimum reward.
Exactly. Cycle thinking gives you the professional permission to simply do nothing when the environment is poor.
Which is a superpower in trading.
So let's give the listener the actual blueprint for action, a concrete process they can use tomorrow morning. What is the very first thing they need to do when they sit down?
The very first step is to identify the macro. Before you ever open a charting application, before you look at a single candlestick, you need to figure out what is driving global capital right now.
Find the engine.
Yes. Is it a massive shift in Federal Reserve interest rate policy? Is it a sudden energy supply shock in the Middle East? Are we in an environment of globally abundant liquidity or rapidly shrinking liquidity? You must identify the dominant driver.
Once they've identified the beast, how do they track it?
That is step 2. Locate the phase. Now you open your charts.
Okay, now we look at the charts.
Right. You look at the structure and the behavioral characteristics of the market to infer exactly where we are in the cycle.
What are we looking for?
Is price trending cleanly with shallow, quickly absorbed pullbacks? That behavior strongly suggests we are in expansion. Are textbook breakouts constantly failing, reversing, and is intraday volatility violently expanding? That behavior strongly suggests exhaustion.
You use the visual footprints to verify the fundamental phase.
Yes, exactly.
And once they've verified the phase, how do they actually interact with the market? Because they aren't just clicking buy anymore based on a 5-minute crossover.
No, they are doing step 3, building campaigns, not trades.
Campaigns. I like that word.
A trade is a casino bet. A campaign is a strategic, calculated operation.
How do you build one?
To build a professional campaign, you define your directional bias based entirely on the macro narrative. You define your time horizon, which should be scaled in weeks or months, not minutes.
Get off the 5-minute chart.
Please. And crucially, You define the exact, specific, fundamental, or structural conditions that would definitively invalidate your macro thesis.
So you know exactly when you're wrong.
You are not placing a bet. You are managing a living position in alignment with a larger flow of capital.
And the final piece of this blueprint is how you manage your own psychology during this campaign.
Yes, step 4 is adjust expectations. This goes back to the absolute necessity of adaptability. You cannot use the exact same tactical approach in every single phase.
You have to change your gears.
Right. The expansion phase demands that you are aggressive, that you confidently hold for continuation, that you press your winners.
Ride the wave.
But the transition demands extreme caution, drastically reduced position sizing, and a profound willingness to step aside entirely.
Death on your hands.
Long-term consistency doesn't come from doing the exact same mechanical thing every single day. Consistency comes from doing the right thing for the specific environmental phase you're currently in.
That is an incredibly powerful, cohesive framework. But I know human nature. I know traders. People will hear this deep dive, they will love the concepts, they will nod along, and they will still find a way to mess it up when the market opens on Monday.
Oh, inevitably. This raises an important question, and it necessitates a final warning. Because even with this robust, logical framework, people will inevitably introduce human error.
Where do they usually mess it up?
The most common, fatal misinterpretation I see is that traders will take this fluid, organic concept of macroeconomic cycles and try to turn it right back into a rigid, mechanical template.
They'll try to turn the beautifully complex cycle back into a crude whack-a-mole machine.
Exactly. They will assume every single macro cycle must last exactly 3 months, down to the day. Or they will assume every cycle must look perfectly mathematically symmetrical on a chart.
The left side must look like the right side.
Right. Or, worst of all, they will start micro-labeling the noise. They will see a tiny, insignificant 2-day pullback on a chart and loudly declare, aha, a brand new macro initiation phase has begun.
Right, they instinctively compress the time frame again and try to apply grand macro concepts to meaningless micro noise.
Yes, you must always remember that true cycles are nonlinear. They're inherently messy because human beings are messy.
The market is not a math equation.
No. Sometimes a massive expansion phase stalls out for an entire month, chopping sideways before violently continuing. Sometimes a beautifully developing macro narrative gets completely distorted by a sudden, unpredictable black swan news event.
Things change.
If you expect perfect mathematical symmetry from a global market driven by human panic, greed, and institutional constraints, you will be endlessly frustrated. You have to accept the complexity.
This framework is a compass to guide you through the wilderness, not a GPS system with exact turn-by-turn directions.
It guides you, but you still have to open your eyes and navigate the terrain yourself.
What an incredible synthesis of how the market truly operates. I feel like we've just taken you, the listener, on a massive leap in evolution today.
I hope so.
We've conceptually walked you away from the glowing screens, away from the reactive, hyper-stressed, dopamine-driven world of chasing false signals and microentries.
It's a toxic environment.
And we've invited you into the professional realm, a realm where you deal in overarching narratives, psychological cycle phases, and the massive, slow-moving, undeniable tides of global capital flows.
It is a profound, permanent shift in perception.
And the true payoff of this shift isn't just financial, though the consistency certainly follows. The true, lasting payoff is mental clarity.
Peace of mind.
Yeah. Shifting your mind to cycle thinking does not make the market perfectly 100% predictable. Nothing in the world does that. But what it does do, finally, is make the market coherent.
It stops being a rigged casino designed to hunt your stop loss, and it becomes a readable, understandable landscape.
It all makes sense now. The mechanics are visible. So the next time you sit down at your desk, you open your charts and you see that violent, confusing, chaotic price action that seems to make absolutely no technical sense. Don't panic.
Don't force a trade.
Don't immediately go searching for a new custom indicator to download. Don't grip the mallet tighter. Instead, take a deep breath, step back from the micro noise, and ask yourself the bigger questions.
Is the old cycle simply dying its chaotic, inevitable death?
And, more importantly, what is the new macro narrative, the real-world imbalance that informed capital is quietly front-running right now while everyone else is distracted by the noise? Keep questioning the assumptions you've been taught, keep zooming out to see the bigger picture, and never stop looking for the machine beneath the game.